In amongst the recent market and political headlines, trade wars, interest rate cuts, constitutional crisis in the UK, and US impeachment proceedings, two significant things happened within global equity markets during the last month of the quarter that largely went without comment. Large cap growth equities lost leadership, and passively invested assets in US equities outweighed actively invested assets for the first time. These two factors influence markets and our portfolios in different ways, but they are inextricably linked. In the middle of September, inflows into passive US equity products such as ETFs and index tracker funds resulted in the total assets reaching $4.3 trillion, outweighing the total of $4.25 trillion invested by traditional stock-picking active managers. This means that for the first time ever, US stock-picking managers are no longer the guiding force of the market, whilst there are more investor funds now content to simply track the market than looking to outperform by way of active management. It has long been our thesis that, although in isolation passives have no real impact on markets, when investors sell actively managed funds to invest into passives, they're effectively selling cheap companies and buying more expensive ones, widening the disparity between investment styles. Passives are price-insensitive investors, simply buying the market regardless of valuation and tracking it up or down. The longer-term impact of having the majority of assets dedicated to replicating an index rather than seeking to outperform it remains to be seen. But the fact that passive holdings in some companies are now significantly higher than the daily average of stock traded does raise concerns about what could happen should ETFs see a period of sustained outflows. With the continued inflows into passives, it was all the more surprising to see large cap growth stocks lose some of the leadership that they have been enjoying over the last few years. As a multi-manager, we blend market caps and investment styles based on relative valuations, with the result that we generally sit as core, i.e. neither value nor growth biased, across most of our regional equity exposures. This balanced positioning has hurt our relative performance over the last year, as large cap growth stocks have continued their run of outperformance. However, during September, the leadership has been much more mixed, with days where large cap growth fell, while other styles and market caps rose. It's certainly too early to call a full-blown star rotation, but the relative outperformance of our equity exposures within multi-asset portfolios during the last month of the quarter shows that a star rotation is not needed, merely a broadening out of market leadership. After a difficult August, our multi-asset portfolios bounced back in September as our maximum overweight equity positioning was maintained and sit in line with benchmark for both the quarter and year to date. At this month's tactical asset allocation meeting, we maintained the maximum overweight equity positioning that we have held since the start of February. With our model showing positive buy signals across the regions, the split across domestic, developed ex-domestic and emerging markets was retained.